A lot of people like to use the word, oh, hoarding, you're going to put the money into your mattress. Let's be real, they're talking about saving. It would incentivize you to save your money. In fact, if you think about it, people are then saving their money for a little bit longer. They then have more wealth when the iPhone 16 comes out, and then they can make more purchases. When people have more savings and more wealth, they're actually going to spend more. Their behavior is dictated by their preferences, and their preference is for an older phone. They do not value a better phone. And this example is a perfect segue into Austrian economics. And that is why I believe Keynes himself would be rolling in his grave if he saw what inflation has done to our country. In my recent video on inflation, I said that inflation is bad and deflation is good, and I seem to have ruffled a few feathers. In fact, if you're subscribed to the Wealth Potion newsletter, I took it a step further. I said that inflation is theft and deflation is inevitable. I'm going to dive into that topic today, and as I've said before on this channel, my goal is not to sell you anything or to change your mind immediately. My hope is that by the end of this video, you question some of the things that you've been led to believe. First and foremost, I have to address the most common response I got to my previous video about how deflation is bad. I received a similar comment in YouTube comments, on X and on Twitter, and in email replies to my newsletter. And I think this is a very important subject around the so-called dangers of deflation that needs to be challenged. So we're going to spend some time talking about that, and then we're going to build on that. We're going to connect this back to Austrian and Keynesian economics so you have a better understanding of what those mean and how, if you subscribe to a slightly different school of economics, that it will lead you to very different conclusions about inflation and deflation. So without further ado, it's going to be a spicy one. Let's dive in. Okay, first and foremost, we have to talk about the most common argument against deflation, which is what I'm going to call the deflationary death spiral. For instance, a YouTube commenter says that a bit of inflation is good because it incentivizes people to invest their money instead of putting it under their mattress. A user on X said, well, if money is deflationary and it gains value over time, wouldn't you only buy the stuff that's necessary? And then another commenter added, what's wrong with a little bit of money debasement? Doesn't that penalize the people that aren't investing their money and circulating it in the economy? The argument overall is that with a slow 2% inflation, our money, our cash, slowly loses value over time, which incentivizes people to spend and or invest their money. And that is good for the economy because when you spend money in an economy that's measured by GDP or gross domestic product, which is ultimately consumption, then that is good because you're going to be giving your money to businesses for products and services. Those businesses are going to employ people, and that's going to make sure that most people have jobs. And the inverse of that argument is where people typically have a problem with deflation. Because now if you imagine, if instead of the money getting 2% weaker over time, what if the money were getting 2% stronger over time? That would then be an incentive not to spend and invest your money, but instead to save your money. A lot of people like to use the word, oh, hoarding, you're going to put the money into your mattress. Let's be real, they're talking about saving. It would incentivize you to save your money. As a sidebar here, I've pointed this out in other videos. This is why mainstream financial advice today is to invest your money, buy assets that will go up in value. And there's nothing wrong with that in the system that we're living in, because that is what you have to do to maintain your purchasing power. You have to invest your money in assets so that you can maintain or grow your wealth over time. And this topic that we're talking about is not whether or not that's a good strategy. It is a good strategy in this system. And what I'm challenging is, what if this system actually has some very negative effects that we will explore? Now, I want to give a shout out actually to one of my good friends from back in Canada. He is actually Argentinian, and if you know anything about the Argentinian economy, they have some very first-hand experience with inflation. So I very much respect his opinion. And my friend sent me a very thoughtful reply to my email newsletter with a well-written, nuanced argument that I want to point out a couple things where I agree and a couple things where I disagree. First and foremost, he pointed out the example of ground beef that I used, that ground beef is not a great example to use when talking about inflation and deflation. And this is absolutely correct. And without getting too much into the weeds, it's because grocery items like ground beef, the demand is inelastic. In other words, when the price goes up or down, it's not really going to affect your spending behavior because, look, you need ground beef, you need to eat. Where inflation and deflation makes a bigger impact is around what's called discretionary spending. In other words, goods that have elastic demand, or to put it really, really simply, things that are more of a nice to have, right? Your phone, your TV, a new desk, furniture, things that you don't need to survive on, but you kind of want. And so he pointed out that if we lived in a deflationary system, let's say 2% deflation, people would likely delay buying that new TV by 6 months. And this is where I have to agree and disagree, because where I agree is that yes, discretionary items is a much better example of where inflation and deflation affects our lives. And actually, if we look at the global economy by industry, we're going to see that electronics has been deflating in price rapidly, much faster than any other industry. So electronics is actually a perfect example because it is a microcosm within our economy where we're actually experiencing deflationary prices over time. So to make this really relatable to you, perhaps you or someone you know always gets that new iPhone. They always want to go out and buy the iPhone 16, I think, is coming out, and they'll get the 17, or maybe you skip one and then you get the 18. But wait, this flies in the face of the anti-deflation argument because the prices of electronics drop rapidly over time. When the iPhone 16 comes out, the iPhone 15 is going to get a lot less expensive. And yes, there are people out there that will delay getting the iPhone 15 until the 16 comes out so that they can grab the 15 for a lower price. But it doesn't destroy the economy. In fact, electronics has seen some of the most innovation and development than any other industry out there. So that is one area where you should really question this belief, which is, okay, if prices were deflationary, yes, people would defer their spending, but it wouldn't lead to some deflationary death spiral. In fact, if you think about it, people are then saving their money for a little bit longer. They then have more wealth when the iPhone 16 comes out, and then they can make more purchases. When people have more savings and more wealth, they're actually going to spend more. So this idea that people are going to hoard their money maybe works on a 1 to 2 year time scale, but when they hoard their money, they get wealthier and then they spend more. And another way you can look at this is the opposite. Maybe you or one of your friends is that person that never upgrades their phone. They are the person that has the iPhone 8 or the Motorola Razr or whatever. I don't even think those are still operational. But you get my point. They have the old phone. Now, if electronics were inflating in price over time, let's say the new iPhone, when the 16 comes out, the 15 is going to get more expensive. Would that person that holds on to that iPhone 8, are they going to upgrade in a world where the price of the phone is going to keep going up? Probably not. Their behavior is dictated by their preferences, and their preference is for an older phone. They do not value a better phone. And this example is a perfect segue into Austrian economics. If you remember in our last video, we talked about how Keynesian economics, which has largely taken control of the mindshare of most economists today, is ultimately founded on the core principle that the management of aggregate demand in the economy, more people wanting more stuff, is what leads to a healthy and stable economy. In other words, you could think of Keynesian as largely top-down in terms of managing the economy. Quite literally, they believe in a central bank pulling levers to manage the economy in slight or not so slight ways. Austrian economics is basically the complete inverse of that. It believes that the economy is driven by individual human action, which is influenced by our subjective desires, wants, and needs. And it is the free market that is best able to manage and create a stable economy with minimal government intervention. These two worldviews could not be more opposed. And don't get me wrong, there are areas that they agree, but the foundational beliefs are practically opposite. And so to the example of phones and electronics as a very real deflationary industry, we see human preferences win the day. People want more technology. They want the faster iPhone. They want the more megapixel camera. All of those preferences on an individual level dictate that people want these things, and it doesn't matter if the prices are decreasing over time. Maybe people will defer their purchase 6 months or 12 months until the next phone drops, but they're still going to make purchases, and they're still going to contribute to that microeconomy. Another quick side note, I want to go back to this chart because electronics, as we pointed out, is one of the areas where we see a ton of deflation, and the industry works just fine. In fact, you could say it's thriving. When we look at the industries that have the highest inflation, we see healthcare, we see housing, and we see education. These are the industries where we see perhaps the most government intervention and regulation, whereas electronics and these other industries that have extreme amounts of deflation are generally where the government gets out of the way. And so that's a topic for another video, but to the Keynesians who believe that the government should be actively managing the economy, I'm fairly confident that the data is showing that this is not the case, and we should actually be allowing free markets to operate on their own accord. All right, so I've pushed back on what I think is the most common misconception about deflation, but I would love to hear your arguments. Please do keep adding comments, keep engaging on Twitter, keep replying to my emails. I would love to keep this discussion going because this is how we learn and this is how we get better over time. It's by challenging ideas and through freedom of speech. So look, I can take it. I got thick skin, but I'd love to continue the discussion and answer your hard-hitting questions around inflation and deflation. So I've kind of touched on why I believe deflation can be a good thing. Now let's go back to inflation and why I think it's bad, even if it's only 2%. And I'm going to go back to what I wrote in my email newsletter, which is inflation is theft. There's a famous economist that wrote, and let me quote here, "By a continuing process of inflation, government can confiscate secretly and unobserved an important part of the wealth of their citizens." That economist was John Maynard Keynes, and that is why I believe Keynes himself would be rolling in his grave if he saw what inflation has done to our country. In fact, here's another fun fact about Keynes. In 1930, he wrote an essay called Economic Possibilities for Our Grandchildren, and he predicted in 100 years, which would be 2030, so 5 years from now, that we would have a 15-hour work week. Look, I know it's not 2030 yet, but I think it's safe to say that he was off base on that one. And it's fascinating if we dive into exactly why his prediction was so off. It's obviously a very complex prediction to make, so I'm not going to break it all down here, but I think largely he made that prediction for two main reasons. One, because of technological progress, and two, because of capital accumulation. And as discussed earlier, the areas of the economy where we see the most technological innovation is where we see deflation, which the Federal Reserve and central banks are actively fighting against because they have an inflation target. And secondly, capital preservation, that is where I'm going to argue that inflation is theft. Because inflation quite directly debases our money. And again, I know what people are going to say, well, you're supposed to invest your money. You're not supposed to save it and hoard your cash. Yes, but that is part of the problem, and that's what contributes to wealth inequality. I love what Saifedean Ammous says about this, which is basically that the fiat inflationary system that we live in today forces you to have two jobs. If you're a doctor during your day job, but then you have to be your own hedge fund because you have to manage your investments in such a way to grow your wealth over time, or at least even maintain your purchasing power over time. If you're a lawyer, if you're a business person, it doesn't matter what you do for 40 hours a week in your day job, you also have to be a financial analyst. Not only that, but financial assets in and of themselves are not accessible to everyone like cash is. If you are in the lower or lower middle class, you might not have access to assets. And certainly as you move up the net worth ladder to the higher classes of society, you get access to more diverse asset classes. As an example, fine art is really only an investment vehicle for very, very wealthy people. But even at the lowest rungs, something as simple as buying stocks on the stock market or buying an index ETF is not accessible to a large proportion of society. And Maybe in the United States, most people have access to a brokerage account, but certainly globally, inequality is fueled by the fact that cash loses value over time, and in order to maintain your wealth, you need to buy assets. And one more point here, I know this is a long video, but it's very important, and if there's interest in this, let me know. I will do a deeper dive video. But yet another way that inflation steals our wealth is that it incentivizes borrowing. It benefits the borrower at expense of the lender. And you might be thinking, wait, isn't that backwards? I thought if you're in debt, then you're actually indebted to the lender. While yes, that is true for high interest debt, like credit cards or student loans, again, the debt that most lower class people only have access to or are required to take on, the other more valuable forms of debt, such as mortgages or lines of credit, these have extremely low interest rates. And isn't that funny? The more wealth you have, the lower interest rates you have, and therefore the better off you are in this debt-based system. And the reason that inflation makes borrowing even more beneficial is quite simple. Because if I borrow $10,000 from you at 2%, so in 1 year I'm gonna pay you back $10,200. But if inflation is 3%, then I am paying you back $10,200, but those $10,200 a year from now are less valuable dollars by 3%. So in terms of purchasing power, I've actually taken value from you because I borrowed $10,000 and then gave you back money that is worth less than $10,000 in purchasing power. This is a mind F of a concept, and it's definitely another video I will talk about. Essentially, it's how money is a unit of account, and when you see the number go up in your bank account, you think you're getting richer and wealthier. That might not be the case, and that is why inflation is especially sinister. At least with government taxes, you see it come out of your pay stub, you know that you're paying 20, 30, 40% tax. Inflation is under the surface. It is not seen unless you really dig for it, which is again why it's such an important topic to understand, and it's also why I will be posting many more videos on this topic in the future. So if you have any questions, let me know in the comments. If you disagree, let me know in the comments. But overall, if this video felt interesting and valuable to you and it challenged some of your perspectives, I would highly appreciate if you like and subscribe to the channel, because that's really my goal here. It's to challenge us, it's to make us better, and it's to open our mind to a possibility that what we've been taught about inflation is actually leading us astray. So thanks for watching, and I'll see you in the next one.